Good morning. David, confirm that you can hear me and see me also.
Yes, Abby, we can hear you.
Thank you. Good morning, everyone, and welcome to our second virtual media training for business journalists. My name is Abija Kanene, and I'm a senior manager in marketing, knowledge, and communication in KPMG. I would like to appreciate you for creating time to join this training. Last year, we conducted a training that was aimed at supporting you in interpreting financial statements and understanding different taxes that you have in the country and around the region. Media Council also took us through a session touching on ethics, among others. Today's training is on ESG, and we'll also be looking at international financial reporting standards, what we call IFRS. ESG has become a top priority in organizations around the world, including in East Africa, and there are reporting requirements that are being implemented. So as a journalist, how do you report on this? I'd like to take us through some housekeeping rules as we start this session. Sharon? So you're joining this training session with your mics muted and your videos disabled. We would also ask you to put your phones on silent just to avoid these, distractions as you concentrate on this training. This session is being recorded. We would like to encourage you to use the Q&A box or that function to post your questions. During Q&A, we may ask you to speak, and so we'll allow you to unmute your mic. And we'd also want, when you do that, to let us know which organization you present. So we have an exciting program for you today, and I'd like to run you through the program of the day. So we're going to start with opening remarks, and the opening remarks are going to be made by Bernard Amuka, who is a partner in KPMG in advisory, specifically consulting governance and risk compliance. Then we're going to also have opening remarks by Victor Bwire, who is a director, media training and development at Media Council, Kenya. Victor will also take us through a short session on media ethics. After that, he'll be followed by Christine Guku, who is an assistant director, training and curriculum development, Media Council of Kenya. And goes. We'll then take a short break, 5 minutes, and we'll come back, and Johnston Nyika, who is a senior manager in KPMG, will take us through accounting standards overview. Thereafter, we'll have Lynette Nyachionjeka and Sarah Njoroge, who are both managers in advisory, and they'll take us through ESG and social governance. And just to mention, Lynette will also come during the accounting standards overview to talk a little bit about IFRS 17. Then we're going to have question and answer session, which will be conducted by David Waithera, who is a manager in marketing, knowledge, and communication. And then we're going to have closing remarks. So if you'll allow me, let me welcome Bernard Amuka to make the opening remarks. Over to you, Bernard.
Thank you very much, Bija. Please confirm you can hear me.
Yes, I can hear you.
Thank you. Good morning, good afternoon, good evening, depending on where you are. As been mentioned, my name is Bernard. I'm a partner in KPMG Advisory Business in East Africa. I'm very excited this morning as you join this training. For me, this is the third training that we conduct together with the Media Council of Kenya. And therefore, we do appreciate the opportunity and the business partnership that we've had together, working with you as the media key players to bring to life the specific key agenda that relates to topical issues that are in the environment and which are affecting how we operate as an entire economy in the East African region. So I'm very, very excited at a personal level and even at KPMG level for us coming together to handle this training for you. Our intention really is not to change you as journalists to being accounting or auditors or being changing your career, but to be able to journey with you to understand what specific key aspects of reporting you do and how it impacts the economy and what specific areas you may need to be focusing on. So this morning, as part of KPMG program, we will be walking you through what ESG reporting landscape looks like, the regulatory pressures that are building up from various stakeholders, the investors. We see a lot of pressures from the stock exchanges, from the capital markets, for companies, particularly listed companies, to embed and disclose how their ESG agenda is being implemented in the business. So these are really about ESG integration, how the boardroom looks at like it, and how it is reported. So we'll take you through how the various frameworks for reporting, but also at the same time, reflect back and give you some insights on how you can look at the reports and challenge or even create news within the ethical guidelines that you have within the media. So really, I would not want to take a lot of time in taking this because we have quite a number of professionals who have deep experience in the reporting standards and will be telling you or will be sharing with you how these impact reporting in the various companies that you would be interested in reporting on how they are performing on the ESG factors. So welcome, and thank you Media Council of Kenya for the partnership and bringing us together on this. Back to you, Abija.
Thank you so much, Bernard, and especially for highlighting that the media has a role in educating the public on ESG matters. I'll now welcome Victor Bwire, Victor to make opening remarks and to proceed with his session on media ethics. Welcome, Victor.
Abija, let me give an apology for Bwire. He started another meeting at around 8:30. And he's a key contributor in that meeting. So he's not able to join us at this point. Let me just take the opportunity to make some few remarks on behalf of the Media Council of Kenya and say that as a regulator of the media and looking at the standards of journalism, I must say there has been some level of improvement in how financial news and business news is reported, but there's always room for more. And I say there's always room for more because the business industry is actually changing. How people conduct business is changing, just as the world is changing. Different aspects of how business is conducted are coming up. Different models are being adopted. And so we must also change our business approach in writing stories. At the same time, if we look at ESG, it's now becoming a big issue, especially with a focus to climate change and how we as human beings, we as people, consumers of services, providers of services, how we use information is also changing. How we share information is changing. So the social interaction about business information is changing. And so because of that, business models are changing. Even approaches to getting clients, meeting client needs is changing. And because of that, as the media, we must also begin to look at the social aspect of business and business models that are being adopted around the world, and even looking at our own business sphere in Africa, in Kenya, in the counties. What kind of business models are being applied, and are they working? And if they are working, what is it that makes them work? What is it that makes them unique? What is it that makes them more innovative to meet the needs of the people that they seek to serve, of the services they seek to offer? And so as journalists, speaking from a journalistic perspective, we must also explore what are the ethical issues that come with the new models. Are there things that the business community is doing that we need to look at? And when we look at them, do we risk violating our code of conduct? And how do we go about that? And when we do those stories, how do we hold those who are conducting business to account? How do we look at question of integrity? How do we look at the question of governance? And what are the issues that we need to look at when we think about ethical reporting? If business is being conducted online, who holds anybody accountable? Not too long ago, there was a story about companies that have set up, I would say, establishments online, but they are really fake companies. They have picked up people's identities and posted them as their own, and they have fleeced people of money, pretending to be who they are not, pretending that their business can offer this, that, and the other, which they really cannot. And so as journalists, we need to begin to look a little wider and to think about the emerging issues because of the digital platform, which is, if you like, a free-for-all. It's a place where anybody puts in information, takes out information, collects data and information about other people, collects business information about other companies, and can even apply that information without necessarily having anybody to hold them to account. So it's important for us as journalists to pay attention and look at what are the emerging issues where people could be conned, could be fleeced of their money, could be lied to, could be given information that is not accurate, could be engaged to take up services that really do not exist. So it's good for us to also look inward and say, what are the emerging ethical issues, and to begin to look at what can we apply. And when we do that, we also think about our audiences. Who are our audiences? What kind of information are they looking for? Are we the only providers of that kind of information, or are there others who can provide similar information? And how do we make our information cutting edge, such that they know they can trust the information that we give as the media, that they know that they can follow up on this information that we give, because we will do the story end to end. Not leave people hanging. We give them information and then it is half-baked. There is information which is true, yes, it is factual, yes, but it only gives one side of the story, or gives half of the story. There is a part two where people are left asking, and so how does this impact on me? And how can I use this kind of information? So we need to think about our packaging of the stories, how we tailor our information for our different kinds of audiences. I know that at least in Africa, I know there will be people who will be consuming this information in different languages. Are we able to unpack that business jargon to our local languages and be able to share that information with our audiences and communities that consume information from us as the media? So those are issues that will be good for us to think about during this session. We may not have too much time to think about them, but it's good to just give them a thought. And maybe after we have done the training, we can go away exploring what are the solutions that we can offer in terms of the kind of information we offer and also the audiences that we send our information to. Is the information relevant? Is it information that they can use? Is it easy to consume that information? I want to stop there with the remarks and say I am really delighted and excited to be part of this training. Thank you very much.
Good. Thank you, Christy, for taking us through that, short and brief session. I like the fact that you've talked about emerging issues, and even ourselves as businesses, we're also looking at that. And it's just good to know that even for journalists, the emerging issues are also influencing their reporting and the need to cast their net wider when they're looking at reporting on business matters. I guess I'll also invite you again because it's your session that is coming up, and welcome again, Christine.
Thank you, Abija. So I want us to just take a quick look at some of the ethical issues that we can explore. You can put up Victor's presentation. I'll go through it really quick, and then I'll pick up on my presentation. We want to look at the place of ethics in journalism and say that there are various regional professional bodies to which we belong, we as the Media Council. There's SBJ, IFJ, KJ, CBA, CPA. All these put us, if you like, on a check, such that we are able to respond to queries and questions about stories that we put out there. Don't imagine that when we do stories as journalists, no one holds us to account. There are regulations that hold us to account. Society even demands accountability from our end, where we say, we have done a story, but is the story accountable? Is it a story that is based on facts? We also have a responsibility to society to give content and information that is of public interest to them. And at the same time, we also do what we call self-regulation. We look inward and we say, what is the good thing to do? What is the right thing to do? So in terms of that, we have developed a booklet called the Code of Conduct for the Practice of Journalism, at least for Kenya. I know many other countries also have the same, and they try as hard as they can to adhere to that code of conduct. But at the same time, in our constitution, we have laws of on defamation, where we are able to cover people, but cover them in a fair manner, not to put them to disrepute without having any facts. So it's important for us to always think about the stories and what we are saying. Is it factual? Can someone come up and say, you have defamed me? So it's important for us to do that. Because we also have the regulations, and these regulations they protect people. Our biggest bit. Just go back to the last slide. I don't know if I'm able to control it well from my end.
Yes, Christine, you are able to control.
Okay.
Yes.
I'm trying to go backwards. I want the one just before this, minimize harm. But I'm going back and it's not taking me back quickly. In journalism, one of the biggest things that we do is to seek the truth and to report that truth. So in whatever story we find, whatever lead we find, we have to look at the accuracy part. Accuracy is the first of our clauses in the Code of Conduct. And accuracy is critical. It's paramount to any story that you do, whether it's a business story or not. Accuracy is critical. We must seek the truth. And the truth is based on facts. So either you have data which is documented, or you have spoken to someone who is an authority in a particular field or in business, and you're quoting them. Remember, as journalists, we tell the story. We are never the originators of a story. So we are never a source of a story. Unless you have come out of journalism and become maybe an investor in something or started a business, then you can be interviewed by another journalist to now be able to be reported on. Otherwise, it becomes very difficult and a little complicated when you are reporting on yourself, because then we ask the question about objectivity, balance, because you're reporting, and biases because you are reporting on yourself. So accuracy is really, really critical. And then there's the question of fairness. We need to be fair, seek news sources and subjects to respond, if it's to criticisms, to allegations, even to commendation. I will say when you seek fair comment, you're not always looking at the negative story. It could be that somebody has said something positive about a certain business. You need to go to that business and actually ask them, is it true that, you know, this and this and this is what you're doing? Because they, from that, as they are confirming or affirming what it is that has been observed elsewhere, you may actually find that you get another story from their affirmation, or they are confirming what it is that you have found out. Again, you might also come out with a new detail or a new in-depth look at that business. So fairness is not always about a negative story. There is the question of responding to criticism, yes, but there's also affirming positive comment that comes in. Public good versus individual good. You know, every time we do our work, when we wake up in the morning, we are going out there to write stories for the public good and the individual's good. Anybody who picks up a newspaper, anybody who goes online to read, or anybody who switches on a TV or a radio is looking to get information that can be beneficial to them. So in that case, we are always looking to do something that is of public good, something that is of public interest. People want to know the information that you have spent your day gathering. Why should I care? And later on in my other presentation, I'm going to talk about why you must think about that question of why should I care? It's critical for you to always think about why the audience should care, because if you do not think about why the audience should care, you may find that you're actually putting out information which is not useful to the audience. The audience might think, oh, well, yeah, you have given me this information. As a friend of mine would say, is useless facts. So always we must look for what is it that people will gain out of knowing or having consumed the information that you give. And then again, we think about plagiarizing. If somebody has written some information and you take that information and put it into your news, it's important for you to acknowledge that you have this information from somewhere else. Quote the person, quote the source, quote the report, quote wherever you have obtained the data and information from. Remember, I said we are never a source of information. So it's important for us to do that quoting. So in conclusion, I'll say reporting the truth is critical. The second thing that we must really do is minimize harm. Treat sources, subjects, colleagues, members of the public as human beings. And when I say as human beings, do not go out there with the objective of tarnishing their name. I must finish this business. This business, you have heard all the rumors from your friends, or you have heard all the rumors from other media or from other platforms, and you have decided, I'm going flat out, I have to make sure that this business gets dissolved or this business goes out of business, for the simple reason that, you know, you have the rumors you have heard. Look, you need to think about the effect or the impact of the story that you're going to be writing. It could be a positive impact. It could be a negative impact. Now you need to think about treating those people the people who are employed in that company, the investors in that company, you need to treat them as human beings, even if they have done wrong, even if they have embezzled funds, even if they have fleeced people of money. Talk to them with respect because they are human beings. Talk to them maintaining their dignity, don't use words that, remove their dignity from just being a human being. Let's deal with the business story as a story which is detached from the individual human being. So it's important for us to minimize the harm that our story will do. Balance the public's right to know against the potential for harm. And we say this because it's really critical, because the information that we share out there in stories usually has an effect. People react, people respond. And when people respond, it could have a negative effect. So think about it. Is the story that I'm going to put out there going to have a negative effect? And if it is going to have a negative effect, what is the ripple effect that it's likely to have? Is it likely to have people go out there to demonstrate? Sometimes that might be a good reaction that we are looking for, so that people can react in form of a demonstration, but to make a point, to make a statement, maybe to whoever it is that is maybe running a business, or some form of use of monies and finances. It could be even how money has been used, which has been allocated by the government. But we must think about the potential for harm and see what is the likely potential for harm. What is the likely reaction response? When people go out and demonstrate, and it's a peaceful demonstration, that is fine. Because what that is likely to have is that it will have a response. The government will respond, the business will respond, the investors will respond in that way. But if the response is going to, move towards violence, is going to move towards harming individuals, then we want to pull back and do it in such a way that, yes, we still send out the message. Yes, we still get a response or a reaction from audiences, but we save the human being. The human being still remains safe and secure. It is also important for us to recognize the legal issues that affect our stories. We could do a story and it ends up being a subject for defamation or a subject for libel. It's important for us to be very, very careful. Again, you must also think about the data and the content of information that you gather from businesses. You need to protect the business. You can't just share all the information about a business. If you share all the information about a business, it could have some harm on that business. And when that happens, it might have a negative effect on you first, because you could easily be sued. Again, it could also have a negative effect on you because you could easily be fired for putting the media house in jeopardy, by doing a defamatory story and so on and so forth. So you need to be really careful. Again, you must protect the data and information that you have collected. It's important that businesses know that they can trust you with their information and that you will only use what is necessarily important for you to share about a business. So it's critical, it's key that you think about the data and information you have collected, what they have told you. This is a bit private, this one remains confidential, but it gives you a good background of how you do your story. So it's critical for you to also think about the businesses when you minimize harm. The third is acting independently. The picture there actually speaks about this whole subject. Many times we can easily get compromised as journalists because the people who we cover are looking to get a favorable story. And sometimes because they are looking to get a favorable story, it's not always that we are looking for a favorable story. And they might look to compromise us. The picture you see on the screen shows somebody sharing money, and there's a brown envelope underneath. I think that question of the brown envelope. It doesn't matter the color of the envelope. It is an envelope nonetheless. It is where you can get compromised easily so that you hide certain details of a story, or you literally just don't do a story. Remember, we are serving the public good, public interest. And when it comes to financial reporting, we are always running that risk. We become targets for compromising. We become targets for people who want us not to cover their story. And so we ought to develop that very thick skin, that tortoise shell, not to be compromised so that we can serve the public good, remain ethical, carry our integrity with us. Advertisers will come to the media house and they'll say, look, you can't do a negative story like this when this is the kind of advertising money we are putting into your media house. And that puts us in a very serious and difficult dilemma. And yes, we must be in business. So we will continue to take the adverts, but we must also show them that we must have editorial independence, where their advertising and our doing a story on the editorial platform have nothing to do with each other. In the story, we are putting out facts. In the story, we are putting out credible information. In the story, we are informing the public for their own interest and for their own good. On the other hand, we are seeking advertising so that we can build our business, so that we can also pay bills. And so independence from advertisers, owners, sometimes even the government, is very important. And this is one of the things that you must always carry around with you as a journalist. It may not even come in terms of money, and it may not even be directly to the media house. It could be something that looks harmless, but it is a way of compromising you. And sometimes they might do this before the event. If they know that there is something that is likely to leak out to the media, they could actually give you vouchers for free lunch at a certain place. You get compromised in a very subtle way without you knowing, without you recognizing it. They could give you tickets for a holiday. They could give you, they could even give you just, a souvenir. They could give you a nice watch. And that compromises you, because every time you go to do that story, your mind always goes back to, I'm wearing a watch that they gave me. Or I went on a holiday that this particular organization or this business was involved in. So we must be completely careful. And we must also be able to stand up and say, we have editorial independence. So as a media house, we need to claim that editorial independence. But as individual journalists, we also need to act independently. I will say that this is really, really difficult. And having been a journalist, it's really tough. That acting independently, it's really, really tough. You don't even see it coming sometimes, but nonetheless, it does happen. Then finally, I want to talk about accountability and transparency. Take responsibility for your work. Any story that you do, be in that kind of a position where you can actually stand by it, go to court and stand by your facts, understand the corporate governance issues. And because we are talking about ESG, and governance is the G part of the ES, it's important for us to also understand the corporate governance issues, so that when we write about them, we are writing accountably and we have transparency. We are also seeking to expose what may not have been exposed. Expose unethical conduct, even in our own media houses. Our media houses are business entities, except for maybe a few which may not be. They may be maybe charity, maybe church-owned, and so on. But majority of media houses are actually a business entity. Are we able to look inward and say, there is transparency, there is ethical practice, there is integrity? Do we ourselves have a chance to look inward and actually write about our media organizations? It's really critical, because one day someone external is going to actually look inside the media houses and might find us with questionable conduct, with questionable behavior. And so it is good for us to actually look inward. And when we have made mistakes, acknowledge those mistakes, own up, but correct them as soon as possible. If you have written a story which has reflected a certain media house negatively, it's important for you to always go back, apologize as fast as possible. As soon as they point it out, it's very important for you to own up and say, we made a mistake here, or this was inaccurate, we wish to correct, and say this is the correct position. And then encourage dialogue and feedback. Encouraging dialogue and feedback keeps you in communication with your audience, with your subjects for news, with your sources of information. It's good for you to know, what did they think about the story that you wrote, whether it was positive or it was negative. There's this relationship that needs to continue existing between business entities and media houses. It's very key for us to keep a relationship with business entities, business organizations, business people, individuals, and so on, because they are our source of information. And we are the channel or the platform on which they can ride to get their information out there. It's really, really key. So we can never burn those bridges of keeping the relationship between ourselves and business entities. As I close, reporting tips: report on issues professionally and in a creative manner, and make sure you're balanced. When we say balanced, we are not just saying put male and female, but also what is the content of what the people who are speaking saying? Is it balanced? Does it lean on one side where everything looks bad, 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 bad? Again, remember, our audiences can get depressed by us giving just very depressing news. You talk about recession, you talk about the economy is not growing, you talk about there's not money growth, you talk about the shilling is losing against foreign currencies. Man, you depress the audiences. So think about the audience and say you need to find a balance. Don't depress them with the business news and business information that you're giving, because remember, they are consumers of information, and the information they consume. Always think about the professional way to balance your story. Research, research, research. I'll still talk about research again in my next presentation. Research well, and be sensitive to people's cultures, be sensitive to business practices that are different. When you go into a hospital as a business, because hospitals run businesses, if you go into a hospital and you're trying to, capture who their clients are, remember those are patients. You need to seek permission. So you need to be also sensitive to the nature of the business itself. Highlight the positive stories on business. Don't always look for the negative. Who is losing? Who is running out of business? There's always a positive side to business. The other day, I was thinking about all the good things that happened during the COVID-19 pandemic. For those 2 years, believe you me, I know a few Kenyans for whom, if COVID had not happened, they would never have made the breakthrough they have made in their businesses. Others started a business, a new business idea was born out of COVID, for the simple reason that now the world was needing totally different products, totally different services, and so on and so forth. I mean, I'll even just give you a quick example. There are those people who started selling groceries door to door, because remember, we had been told to stay at home and work from home. So we were not going to the market. So what were we doing? How do we get groceries? How do we get food? There are people who started running errands, local courier services, I'll call them local courier services, of carrying goods from one point to another. Even the supermarkets started having a platform where I can pick a list, I can give them a list of the shopping that I need, send it to them. They will task somebody to collect it. I will send somebody, to pick up the goods. They have been packed well, and they will be brought to the door of my house. I have done my supermarket shopping without going anywhere. And that is still continuing. Previously, everybody just went to the supermarket and bought their things and came back home. But now they have now that other part. This is an addition to the business model that they had. Remember? So think about some positive things that happen even in the darkest of times. Do follow-ups on stories that are carried earlier. Follow-ups is always good because it says, and then what happened? And then what next? And what does this mean? What is the interpretation of what you told us yesterday? You know, do profiles of emerging tax business trends, leaders, even politics. Right now, our country is in a political season. I want you guys to look at the business opportunities there. And I'm not talking about the making of t-shirts and posters and banners. Think about other businesses that are actually happening, and think about, do I want to call them cottage industries that are actually growing now because of the political environment that we have now. Think about people who are now going to get into the tax bracket because of the political season, and they were not there before, making a difference. When you do interviews with the politicians or the people who want to run for office, ask them what is their thinking about taxation. You know, sometimes we let them get away scot-free without us putting the hard questions to them. Think about the business part of their political campaign. What do they have? You know, every one of them has a certain manifesto which they have on their back pocket of their jeans. Tell them to pull out that political manifesto. Let them tell you what they are thinking about enhancing businesses, taxation, what is going to happen if they get that office, and so on and so forth. Investigate and expose any lapses or any rot in the counties. I mean, look, we were given a broken down governance system where we have the central government and then we have the counties. Down there at the very grassroots governance level, where money is actually disbursed. How is that money being used? How has that money been used over the last 5 years? You guys have quite a lot. Now is the time for you to give us a red card. You give us a red card between now and the day of polling so that we can know, do we want to put back the same leaders? Do we want to look for a new set of leaders? What are some of the demands we can make of the new leaders that are coming in? Do for us a good rate card from a business perspective so that I know if I'm running a business in County X and this is the business that I am doing, am I likely to grow when the next one comes or not? Did I grow? What happened? Did I suffer? Did they impose too many taxes at the county level and too many levies and fees such that small businesses were unable to operate? You know, those are things that you need to do. And then finally, please think about using data. Data is very key. Data is critical because numbers speak, and always relate those numbers to something that the audience can relate to. If you're writing a story, and this is something that I'm going to talk about maybe at some point, if you're writing a story about billions of shillings, please put that billion in terms of classrooms, in terms of a toilet block, in terms of maybe a school field. I mean, let it be something that I can visualize as a consumer of that information. And then let's also think about writing stories with impact. If you write a story and the people read and they don't react, they don't even make it part of their conversation every day, for sure, you have not done very much. So look for the unique angles to stories, research the stories well, the facts and the figures, and break down those figures. Don't tell me 50%. What is 50%? Translate that 50% into something that I can think about. You know, I remember when I was taught maths, and you know, the reason why I went into journalism is because I may not have been very good at maths. You know, our maths teacher was always telling us 50% is one orange, you cut it into half. That half is 50% of the orange. You know, so always break it down so that it's easy for your consumers, your audiences, to consume and be able to easily understand and break down. Balance the story, be very objective. Always make sure you have brought in all sides of the story. Always make sure also the kind and quality of comment is balanced. the sources of the story. If you have more interviews, even better. And those interviews need to be telling us different aspects of the story. At another time, maybe I might be able to meet with you and I will train you on interview skills. When you conduct an interview, you interview 5 people, please don't ask them the same question. Know the reason why you are asking this person these questions. Create another set of questions for the next person that you will interview so that you move your story. This one has told us this is how this business is starting. The next person, ask them, okay, the continuation, the next part of your story, so that your story flows with the sources and the people that you interview. Use quotes. It's always fantastic for us to hear what a person said. Quote them even if you're on a digital platform. Make sure you also include, actual quotes in the specific print platforms. Even if it's even if it's a blog, quote someone. Even if it's a newspaper, quote someone. So let's keep on going. It's important for us to just keep this going, so that we have those quotes. We hear the people's voice. Weave or structure your story very well. Avoid repetitions. Check the use of language. Sometimes typos, names of people misspelled, titles put in the wrong way can be a little irritating to the audiences as well. So please make sure that you do that. And then spend more time on the opening paragraph. I'll talk about that in the next presentation. And because I have touched on some of these things, my presentation is going to be really quick. Thank you. So I don't know whether I continue or we take maybe 2-3 minutes to do some question and answer, and then we move on.
Thank you, Christine. We have one question where a journalist is asking, this is Marlon Ichiria. So should journalists not report stories that impact negatively to organizations or companies, even if they are violating their employees' rights, or how should such stories be reported? Probably you can answer that, and then we go over your presentation so that we can get into the other presentation from about 10:15. Thank you.
Thank you for that question. No, journalists must report on stories that are negative and that could even have if you like, a negative outcome. A negative outcome, it depends on how you want to define a negative outcome. A negative outcome could be that now a particular organization or a business becomes a subject of investigation. It's negative, yes, but it's positive in terms of impact. It's positive because now we can get to know the truth, and now we can get to see what that particular organization has been doing. So it does not mean that we do not a negative impact. If it's a negative impact which is going to cost lives, think about it a second time. Seek a second opinion. Look for a more subtle way to put it so that we do not have loss of life. Okay. So it's really good that you do cover all the stories. We cover all the stories. Having been an editor, I also will say, if you go out there and then you come back and tell me, hey, I've done a story, but I think it will have a very negative effect, let's not carry the story. I will give you a memo first, and then I will tell you, give me that story, because I will still run that story. So thank you. Allow me to just go into my presentation real quick. Some of the questions might also be answered here. Now, at this point, I want everyone to be sent the question. There is the first question that I had requested that we do, all of us together, and you can answer it, you can respond to it on the chat, and then someone is going to just give us quickly just a perspective of the responses to those questions.
Sharon, would you like to do that as a poll question, or Sharon?
Hello, Abby. Yes, you can run the first poll question.
Yeah, please go ahead.
Okay, as you do the poll question, I'm going to respond to a question which has been raised, which says, when it bleeds, it leads. Indeed, when it bleeds, it leads, you know? And when it bleeds, it leads is because the reason why that statement came is not because the story is negative, is that it has a huge impact on the audience or on the society. When it bleeds, it leads does not necessarily mean it is bloody. It's an expression which has been used, guys. And it's the kind of expression which says, you know, when a story is adverse. Remember, there's the news values, you know, the news values, there are around 11 of them or thereabouts. So when you think about something that is bizarre, something that has a huge impact, I'll even just give you the example of COVID-19. When it came, we were told about it, and we were told this is not ordinary times. And so the headline the next day was, COVID is here, take care, which actually calls for a response at individual level, a response at society level, a response from government level, a response from a national level. So that is the kind of thing we mean when we say, when it bleeds, it leads. But at the same time, remember the Westgate attack? That was a bleed story, and it led. And again, even on the business pages, were stories about the businesses that were affected, which were at Westgate, you know? So when it leads, it bleeds, yeah? And when it bleeds, it leads. Okay, so we can have a few responses. Can I know how many people have said yes and how many have said no? Do factors in environment, social, and governance count in a business bottom line? So how does the environment really, what does it matter in my bottom line? And I'll just say this, in my bottom line, if you can close the question. Okay, thank you. How does it really matter in me making money? Me, I'm just running a Shylock activity where I'm just lending people money, go on the sides and so on. So how does the environment really affect me? Those are things that you need to start thinking about, you need to start thinking about now. So this is how I would want us to define our business. A business is an enterprise or a firm, an organization, involved in the trade of goods, services, or both to consumers. And usually it has a business plan, a business model, which determine the outcome of an active business operation. I know there are many businesses that you cover, we call them side hustles. There are many businesses that do not have a plan or a model, but believe you me, it is just that it has not been put down on paper. The person who sells secondhand clothes at a market, the person who sells vegetables at a market, or sells potatoes, or sells carrots to a supermarket, they have a business plan. I know they grow them, maybe they grow them, and they get them out of the farm, and they are the ones who supply to the supermarket, or they're the ones who supply to the retail market or to the wholesale market. Believe you me, they have a business plan. It is in their heads. They just have not put it down on paper. So just because it is not on paper anywhere, it does not mean that there is no plan. There is a plan. This person got an idea and thought, this is how I'm going to do it. This is how I'm going to get my raw materials. This is how I'm going to get this done, and so on and so forth. Even if the person is sitting at a counter and all they are doing is trading money. Believe you me, there is a business plan somewhere for the stock exchange of this is how we're going to sell shares. This is how we are going to trade. This is how we are making our profit, and so on and so forth. Believe you me, most businesses, actually all businesses, have a plan and they have a model they are following. They might not know, excuse me, they might not know that they have a certain business, that the business model looks like this, but they know how they do it from end to end until they make their money. So every time we write about the hustles, there's always something. There is how they do it and how they do it in the unique way. Look at what happened to the taxi business because of ICT. Taxi business got transformed into what we use today, you know, the likes of Uber. Previously, I would stand up from where I am, go to a street and hail a cab, or find one parked there and start to negotiate with the person. Can you take me here for this amount? This is the amount I have. On a day like today, I sit at my office, or I sit at the market, or I stand at a street and I go to my phone and I find a free car. I look at the price and I decide whether I want to pay that much, and I continue to confirm he's coming here, you know? So that whole business model, the way it was done before, has changed. So when you're writing a story, you begin by looking at what does it do? And writing the story offers you more creativity. It allows you to write an engaging lead rather than bog you down with a straight-laced news sentence, you know, full of data. 30% of taxi drivers, okay, translate for me 30%, you know, tell me 1 out of every 3 drivers, 2 out of every 3 drivers, you know, break it down for me. Writing a story can comprise long form storytelling, you know, those ones which are very long features and so on, where you start a story from somewhere and you go on and on and on and on until you finally come to a conclusion. Where you start this story, you could start with profiling as a person, and then you open it up now to include other people. Or you could decide you're just going to do a profile. You are going to feature this one person who does their business, wakes up in the morning, leaves the house, goes to do this, supplies that, or offers this kind of service, comes back in the evening. You know, you have followed the entire cycle of how they conduct their business. Think about the different creative ways in which you can write that story. Other forms include opinion writing. You can write a business story as an opinion, which is more of writing a critical argument of a particular business or of a particular financial report and so on and so forth. Draw attention to the topic at hand, ESG and the link to business. You know, right now I need you to start looking at businesses, the kind of ESG approaches that they have. There are companies that, or business organizations that have started putting out on their web pages, on their materials, information about how they are saving the environment. Some have put in, they have started saying that they don't use paper because they are trying to save trees. Others have started saying how many trees they are planting. You know, now I know that was part of what was called the CSR. But I dare say now it is part of the business model, saving the environment, you know, thinking about people, focusing on their clients, focusing on the service consumers. So the business models are slowly changing. And I know somewhere in this training, we are going to actually talk about some of those. So link the story to familiar audience experiences. That is really helpful. I want to move on to what is reporting. It's getting the best obtainable version of the truth within the given time constraints. I know. Yes, I had put off the video for just a bit. Getting the best obtainable version of the truth within the given time constraints. You know, the journalists have deadlines, and that does not mean you compromise on obtaining facts. So always make sure that you try as much as possible to get the facts, to get the data, to get the information within the given time constraints, so that you're also able to give your editor your story. Try to be as non-partisan as possible. remaining objective and balanced. Remember, I talked about it in the first presentation. And also highlight stories and issues that are important to the community being served. Think about your audience at all times. When you don't think about your audience, sometimes you could be off the mark. They might be looking for information about a certain particular issue, and you have not factored that in your story. Think of the business community and the consumers of your news. Where is the link between these two? And always be very, very careful, because the business community, and I know they are in the group. The business community always have an agenda. They want to promote and sell their business. You have the public interest perspective. So always make sure that you find a balance between these two, so that the message of promotion and advertising in a clever way through an editorial story does not overpower. You are writing a good story. Provide accurate, interesting, significant here, I underline, and relevant information through constant verification. Always make sure that the information you give is significant to your audience, okay? The starting point for pleasant and unpleasant conversations. When you report, this is the point at which people start talking about, hey, did you see what was on TV? Did you hear what was on so-and-so's blog? Those kinds of things. When we think about the business beat, we must use the ESG lens. There's all these different places and sources of news that is business or finance related. But you must think about the environment. Agriculture and mining. What is the environment angle to those things, to agriculture and mining businesses? Organizations ranging from house decorators. I've moved to the almost like the fourth one. Organizations ranging from house decorators and consulting firms. What are they doing for the environment? What are they doing for that social construct? And even entertainers. These are types of business services. But then again, are they doing anything for our environment? Are they doing anything for governance? How is governance integrated in the business models of each of these different sectors? So it's key for us to always think about it. Think about the damages. Sometimes when we write stories, description of property, value, stolen or destroyed, etc. And it could be destroyed because of, an act of nature. It could have been a flood. It could have been very strong winds. I keep thinking very, very much about the windmills that we have put somewhere in the north of Kenya for generation of electricity. And I keep wondering to myself, does that save the environment? Again, what if something happens and there is a major wind which actually carries away the windmills? There's a lot of, there will be just, a freak fire. It could be lightning, that kind of thing. It could be an earthquake. So you need to think about that. The owner, insurance, mode of destruction, theft or loss. You also need to think about the legal actions, investigations. These are the scopes of the business beat. There's a lot to write about business. The clues, are there clues that you're seeing in a story? Evidence, arrests, maybe by the police. And it's important for us to think about all this every time we are writing a business story. And so when you write and you're now thinking about ESG, it's key, it's critical for you to know each of these aspects and to factor them in. Because remember, as I have said at the very, very beginning and in my remarks, I said that ESG is now becoming more and more mainstreamed in business and financial organizations. You have the idea, so what next? Read up on the issue, previous news stories, articles, visit the public library, look up directions, sometimes on Google, and see in which general direction are these kinds of stories, or the kind of stories or the issue you want to raise, in which general direction is interest going. I remember when there was the first story about Bitcoin, everybody was very scared, like, at what? What are you talking about? How are we going to invest in it? I don't know those people. What is a Bitcoin? Is it a physical item that I can see? You know? And you see, there was now a lot of interest there. So you need to be aware about the direction in which inquiries are going. Online resources, there's a lot of information out there. Make use of it, but always cross-check that information to be sure that the information is credible. Talk to people you think are experts on the issue, and make sure that they are, people of integrity. Make sure they are also an authority in that particular field. You know, like, do a background check. Don't just let somebody tell you, oh, you know, I'm a financial expert. Go and check them out. You know, on a day like today, there's data and information out there about people. Yeah. Narrow the facts. Try and explain the story in 2 to 3 sentences so that you are able to explain to your audiences. Then we ask the question, what next? Create an outline or a blueprint, or start filling it, start filling it. Focusing on this person who sells shoes, okay? And then go down all the way to how do they acquire the shoes? Where are the shoes made? And in that, you will also now find there's another side story or a tangent story which is coming, the raw materials for making those shoes. You know, what is more fashionable now, and so on and so forth. So you need to have, you know, like a roadmap, a blueprint, an outline of your story. Where do you get ideas from? From business reports. So be reading, journalists. It's time for us to be reading. From business, daily conversations. So always keep your ears open. What are people talking about? Can you get a business story or a financial story angle from what people are talking about? People could be talking about something simple like, oh, you know, the price of this has gone up. And you can go back and start finding out what has caused that increase. Why are people complaining? Is it that people can now not afford it anymore? Read local newspapers, follow news channels. You know, always go into the Bloomberg, see what is on those international news channels, so that we can move on and get stories that make sense. Yes, in fact, this is a really key slide that I wanted to do. A value proposition for your story. Your story must be the kind which gives something new. Your audience is always asking, okay, so I'm going to feature on the radio. Is there anything new they're going to tell me? I'm going to watch TV news. Is there anything new that they're going to give me? Okay. Potential for impact. Think about it. What is the potential of consistency with the media house, identity and profile? Always think about your media house. What does your media house stand for? And so on and so forth. So I want to just say your editor is always looking for that, but always make sure that you research your story. Make sure you capture the audience. Your editor wants you to capture the audience because he must sell that airtime. He must sell that newspaper. He must sell that online publication. There must be a few hits on it, and customize your story to that segment. I want to stop there and hand it over to the moderator and see if there's any question or issues that they may want me to respond to. Thank you, guys.
Thank you, Christine, for that presentation. Just listening to you, taking us through the last presentation that you've just done and the previous one on media ethics. I was thinking of ESG and just seeing that media houses actually fit in the S component because of the role that you have in terms of how you relay the news and what implications they have on people, the wider public, and the stakeholders, other stakeholders who may be involved in the stories that you're reporting, and just thinking of how you minimize harm. Thank you so much. I think in the interest of time, I'm going to request us to take a 3-minute break. Ideally, we should be starting the next session. So let's take a 3-minute break and reconvene at 10:18 and start off with Johnson Nika, who will take us through the IFRS. Thank you so much. So 3 minutes break and we reconvene at 10:18. Welcome back. I don't know whether there's, okay, I know most features are deactivated, and so you're not able to give me a thumbs up or something of the sort to let me know whether you're back. Welcome to the second part of our training. And I'm going to invite Johnston Nyika to take us through the session. Thank you, Johnson.
Good morning, Abby. Please confirm that you can hear me.
Yes, I can, and I can see you.
Thank you, thank you. And good morning to everyone. Indeed, I'm very delighted to join all of you today. It's my first time to have this engagement with the Media Council of Kenya and you journalists, and indeed very delighted to be with you. So my name is Johnson. I work within our audit practice. I got good experience in auditing financial institutions and large corporates. And really my job this morning is to just give you an overview of accounting standards that are driving business and indeed will be important to you as you do your reports, your business reports. So given the time we have, we selected 3 standards that we'll be walking you through. And I do hope that these then are going to be important to you as you interpret financial results of entities, as you write your stories around performance of businesses, and indeed as you help the public then to then make decisions on investments. So the agenda for this, David, is 3 things. If you please can just, yeah. So we'll tell you about what are those recently adopted new standards that have been adopted by businesses. Lynette, my colleague, will tell you about a new standard that is coming up in 2023, and obviously we'll have some impact on reporting in 2022, and then we'll give a session for just Q&A. So just going straight into it, there are 3 standards that in the last, 3 or so years have made a difference in financial reporting of large businesses, maybe telcos, maybe large corporates, and most importantly, in financial institutions. The first standard is Ifrs 9. And Ifrs 9 is a standard, it's an international financial reporting standard number 9. And this standard talks of financial instruments and how you account for financial instruments. The change came about in 2018, and obviously for most of you will be aware, it was necessitated by the financial crisis of 2008 and the need to then remediate that and ensure that the financial, mostly banks, were then reporting the right values or the right values of loans and advances and mortgages, particularly around the globe. And even more importantly, in our country, where I think in the same period, we saw a number of banking institutions then going down. So the standard itself deals with 3 things. It talks about classification and measurement. And the word classification from an accounting point of view is just that. How do you classify and measure instruments? And the reason why this was important then is once you recognize financial instruments, then measuring them becomes, then there was a proper way of then measuring those financial instruments and then remediating the crisis of 2008 where a number of financial institutions then were not able to pay their debt. So in this case, financial instruments, particularly financial assets, are classified into 3 things. The first one is what you call amortized costs, fair value through other comprehensive income, and just to make it easier for you, you know, once you look at your financial statements, you have 3 or 4 most important financial statements. And what will be most familiar with you is what you call the profit or loss, another comprehensive income. That tells you how much profits an entity has made. There is a balance sheet or a statement of financial position that tells you how healthy is an entity. And then there's a cash flow statement that then tells you, even if I'm making profits, how much cash do I have in my business? So when you classify assets in these 3 categories, these categories will then drive how you account for them. So the income and gain, that gain cannot be reflected in a profit and loss for that period. It's shown as other comprehensive income. So indeed, then how you classify assets then drives how much profit an entity is making. The flip side of this is that if businesses make these decisions, then they cannot change those decisions in the medium term, and therefore certain decisions made at the beginning of an investment period may have a negative or positive impact on businesses. So it's important for you then to be able to pick out those classifications within, particularly on the financial institution financial statements, and then they do not have cash flows or vice versa. Then you can pick that out from your financial statements. I think the biggest thing with Ifrs 9 was on impairment, and impairment in simple terms is just a write down of value of assets. So if I give Johnson, for example, a loan of 1,000 shillings today, is Johnson able to pay 1,000 shillings? If Johnson is experiencing some level of constraint from a cash flow point of view, then we say that Johnson, that asset or that loan that has been granted to Johnson has some level of impairment. Now, why impairment is important? I think for most of you who've had an interest in looking at financial institutions, you realize certain, you know, tier 1 or, you know, the high street banks making a lot of money in the last financial year, and some of the others experiencing some bit of constraint. And what the owners of them, the business will be explaining is that, you know, we've reversed some level of impairment on certain assets that were attained during the COVID-19 period. So yes, impairment in itself is a key thing, and writing down of assets or writing up of assets, given the economic conditions, is then reflects the actual values or the reasonable values of assets. And if you look at the next slide, I just took a bit of snips of the financial statements of the 2 large groups within our region, the East African region. David, if you can move to the next slide. And you see this is just an extract of some of the investor briefing materials that they put out there at the end of the financial statements. And Equity in itself, in its briefing, was saying that they have strictly adhered to Ifrs 9. And this has led to recognition of lifetime risks in asset portfolios. So, and again, KCB, again, a large group within the region, the same thing, that looking at certain sectors, construction after COVID-19, they have seen some level of pressure in those industries, but some of the industries then have come up. But what does this then mean as you write your business stories? It then tells the story behind why would a business then be reversing provisions, or why would they be recognizing more provisions? And provisions is, the other word for provisions would be impairment losses or expected credit losses. The reason is because of the quality of the assets that they might be exposed to or they have invested in, or rather, they could be in sectors that are experiencing high growth or proper industries that then have recovered from economic conditions that existed during COVID-19. I think as we go forward, obviously there is some level of disruption of supply chains, given the prices of wheat, commodities, oil, and all that. So you see some of these comments coming up from, and then being able to interpret that the reason behind that is because of the impairment measurement models that businesses would have taken. And in a nutshell, the expected credit loss model is what is expected to be adopted by particularly all businesses, but particularly institutions and the performance of an entity, the customers they have. And if you have good customers, then you expect, like KCP, they're there for 3 years. We think it's going to be a big thing even going to the future. And even the enhancements that we're seeing being made by the International Accounting Standards Board, just to ensure that the models that are being picked or being adopted by institutions globally are then stable and are able to depict the right performance of businesses. So that's it on Ifrs 9. So keep a close look on it. The key thing remains credit losses. And if you go and look at almost all the listed entities, then you see some commentary on businesses and how they performed, particularly in regards to the impairment losses or the credit losses that we then put in their financial statements. And finally, when you look at financial statements of published institutions, again, particularly banks and SACCOs and other institutions, you see that 20%, I think, of the tier 1 banks, you see most of them will have about 20% of the or the booklet, over 200-page booklet talking about the quality of the assets and the process behind that impairment losses. So as you look at those financial institutions and disclosures, for you to then write a good story that would then explain the performance of the business. New standard that is on Ifrs 16, and this again had rented airlines that have leased aircraft that you're paying over a period of time, rather than recognizing those direct through P&L or profit or loss as I expect to use those branches and leased assets are then brought on the balance sheet. And you will see that most of the entities that are then coming up or changing their models of businesses from owning assets to leasing vehicles or other assets, their balance sheet will continue ballooning the rights to use those rented areas. So as explained on this, so what entities have then been doing is to look at what are the lease contracts that you have for these buildings. Have you leased assets for 5 years? If you have leased those assets for 5 years, then you say, my right to use this asset is the rent expense I'm going to be paying, or the rent I'm going to be paying to my tenant, to my landlord. You then look at those future payments of rent, and then you say you discount them to the current period or the reporting period. That becomes the value of the assets that you put on the balance sheet. And indeed, as I did mention, across all industries, hospitality and all that, we've then seen businesses' balance sheets ballooning. And obviously, when you talk about gearing ratios, which is the level of interest expense that you're paying, because there's an associated liability over a period of 5 years, Then you've seen some level of gearing ratios. Entities that would previously be able to meet their, very good or low interest expense ratios going increasing and of course going beyond certain thresholds. And it's therefore then important for you to be able to understand the reason or the rationale behind this. And more importantly, because it impacts a number of businesses. So that's it on IFRS 16. So as you look at any financial statements, ask yourself, are there assets that have been listed? What is the quantum of those assets? Are they driving the gearing ratios on the opposite side? Are they affecting the gearing ratios? Are the balance sheets ballooning? And are you able to then explain why those balance sheets are ballooning? And now, finally, on what we've been calling the IBO reforms. And I think most of us will be familiar when we say IBO borrowing at RIBO values or LIBOR rates. So LIBOR or IBO just means interbank offered rates. And these are rates that banks will have agreed as base lending rates to then offer certain instruments, maybe derivatives, maybe loans that entities would have borrowed or individuals would have borrowed or governments would have borrowed as part of sovereign boards and so on. So what happened is over the financial crisis period, I think abroad, mainly in the UK and the US, it was then determined that banks were then engaging in manipulations of the interbank offered rate, and this the LIBOR. And what that then meant is you would manipulate a rate to your advantage as a bank, and a number of banks which I've mentioned were involved in this. A number of then banks then would either inflate the value of the LIBOR rate that has been agreed or deflate it, just to benefit either the value of the liabilities that they had or even make more margins and then drive the performance of those businesses. And obviously, you see, if there's some level of manipulation, then it erodes the trust that Christine was talking about. So that erosion of the scandals that came up in that period led to a number of entities being sanctioned across the UK, the US, and most of you, if you read the stories behind this, you see a number of the high street banks in the US and the UK being mentioned in a number of scandals, and a number of people being charged criminally because of that thing. So this has then necessitated to bring an end of LIBOR, and the LIBOR administrator in the UK and the US said that they will no longer be publishing LIBOR rates, I think effective 31st of December. Certain markets are still publishing a number of LIBOR rates up to 2023. But these rates that I'm showing here, the secured overnight trading have been adopted in the US, the sterling overnight index have been adopted, and these others have been adopted in the various markets that you can see there, just then to be able to remediate those scandals that were then experienced in that period. Some of you then may ask, why is a change of IBO important in business reporting or in financial accounting and the reports that you write? This, a change of the interest benchmark has a great impact, because most of the transactions that people would have adopted, most of the products that people would have adopted, and they are longer term products, like a mortgage, for example, will no longer be benchmarked on LIBOR, and you need to look for alternative benchmarks. And then what you're seeing now in our local markets, then the banking entities are then disclosing what they are doing within their businesses and what benchmark they are then adopting to be able to then revalue or remeasure the assets that they had initially picked using the LIBOR rates. So the slide here then depicts just the wide range of products that are impacted. And I think the market then is then looking, and businesses, particularly banks that offer loans, or businesses that have borrowed money abroad, governments and so on, are then looking for a viable replacement of the RIBOR, and ensuring that in the run-up of 2023, then they have an appropriate benchmark that they have adopted for their businesses. So those are the three things that I thought would be impactful to you, and would then help you in analyzing financial results, and give you a way of then understanding why things are changing and moving the way they are moving. So thank you very much, and happy to take any questions as I invite my colleague Lynette to take you through the upcoming standard in 2023. Over to you, Lynette, if there's no question.
Thanks, Johnson. Are there any questions, or I can start and we can do the questions after my session? David.
Well, thank you, Lynette. I think what we can do is we let you finish because this is still within IFRS, and then we can have a look at the question. But also to let our journalists know that we are also responding to these questions live. So you're also able to see the answers to your various questions. So Lynette, you can go ahead.
Okay, thank you, Abby. So good morning, everyone. My name is Lynette Nyachiwonjeka. I'm an associate director in a department called Global Risk and Compliance in KPMG Advisory. I specialize in corporate reporting matters, so financial reporting as well as sustainability reporting issues. So this morning, I would want to take you through IFRS 17, which is an upcoming standard for the insurance sector. So I'll just give you a very high level overview of the standard and a bit of the background of why we are changing the standard from IFRS 4 to IFRS 17, and then we have a Q&A. So just a bit of the background of this standard. So IFRS 17, it has been like an a combination of insurance contracts and service contracts, and sometimes you find elements of liabilities also in there. So because of that complexity, just leaving it to the local regulators and to national, national gaps meant that there was going to be diversity in terms of how these insurance contracts were being measured. So you see probably that in Kenya, the insurance regulator would prescribe a way of measuring insurance liabilities that is probably different from how it is being done in Rwanda or how it's being done in Tanzania. So within the region, it was very difficult for you to be able to compare financial statements of these insurance companies and be sure that you are comparing like with like, because the measurement principles were all different. So for some regions, they will recognize what you call insurance premium, which is the cash that you pay when you want an insurance, as revenue on day one. For some, they will spread it. For some, they will adopt other valuation methods that are applicable to their industry or to their nation. So it's really complicated work for analysts, or especially people like media people, investors, and other stakeholders who would want to understand how exactly insurance companies are making money. So because of that, global comparability was even impossible. You see, you couldn't even compare, even within Kenya itself, because some of the subsidiaries will be maybe applying methods from their global holding companies. You couldn't even compare two entities and come up with the same result or be assured that you're actually comparing the same KPIs. So that diversity complicated the issue for insurance companies. Also, there was no transparency in terms of disclosures. So people would not go to the extent of really disclosing how they would have calculated these complex contracts to come up with a value for their balance sheet or for their P&L. So what that meant was there was little transparency, and now what the standard setters have done is to include a lot of disclosures that allows users of financial statements to understand how exactly these insurance companies are making money. And also the other challenge that was there with IFRS 4 was that it allowed entities to use just historical information. And with the environment now, it's very volatile, things just happen. So like we wouldn't have been aware that we're going to go through a COVID period. So imagine for insurance company that measured an insurance contract way back, maybe in 2015, and probably it projected that if it's a life insurer, for example, they've projected maybe a certain age group maybe would die after 20 or so years. Then came COVID and they would have a lot of claims coming through. So that element of not allowing insurance companies to measure their liabilities almost each and every year meant that most of the information we had was outdated, and it was not like leveled in terms of being market level data. So all that now is believed that with the introduction of IFRS 17, there is now a solution, and all these challenges have been sort of the standard setters have tried to address them, as we will see in the next slide. So now what the standard setters have done is to come up with one accounting model for all insurance entities. So what that means is that entities in Tanzania, entities in Rwanda, entities in Kenya would apply that one model to their insurance contract, which means that there's now going to be global comparability, regional comparability, and even comparing within companies is going to be meaningful now, because we're now all using one model to measure the contracts. It also means that there'll be more transparent and useful information because of the disclosures that have been introduced now. And also, the standard setters have put in a clause where you are not supposed to combine investment contracts and insurance contracts. Previously, you could not tell from the underwriting profit which elements really related to insurance contracts and which elements really related to just the investment component of it. So now you are able to actually tell, because the disclosures are split between insurance revenue and investment revenue. Next slide. So what are some of the key features of the solution? So now the one accounting model that we have, that I've mentioned, looks at three components that were a problem in the past, and they have tried to improve that. So the first bit was the updating of cash flows that I mentioned. So previously, most insurance companies would just measure on day one and lock in some of the assumptions, and they will not review them as regularly as they are supposed to be reviewed. But now, you are supposed to estimate your future cash flows and also update those future cash flows almost on an annual basis. And you're supposed to use current estimates that are aligned to current values. So that brings up the measurement of insurance contracts almost at par with other measurement models for other assets. Another issue with insurance contract was revenue. So the insurance industry was the only industry that would measure cash flows as revenue. all the other industries, because of the applicable standards that were there, were able to measure revenue as they earn it. But with insurance contracts, most of the insurance industry, most of them will just recognize revenue on day one. So when you give them the premium for a full year, they will recognize it as day one before they even offer you that service. So the standard has now tried to address that concern, and now insurance revenue is recorded as services are being provided, and it also excludes amounts that are given as deposits. Those are now separated and they're accounted for under a separate standard that is not Ifrs 17. So you're able to just see insurance revenue distinct as it is. And then lastly, in terms of insurance performance, like I mentioned before, the profit and loss for insurance companies was a combination of investment components and insurance components. But now you're supposed to split the two into insurance revenue and investment revenue, which distinguishes the two key drivers for profitability. So now you're able to really analyze investments revenue on its own and insurance revenue on its own, which we were not able to do in the past. Next slide, please. So who is affected by this standard? So Ifrs 17 is written for insurance contracts, not really the insurance industry. So what that means is any company that issues insurance contract can apply Ifrs 17. So most of the companies that issue insurance contracts are usually our life insurers, our general insurers, the reinsurers, but also some of the banks and some of corporates. They need to relook on some of the contracts that they have that may tend to meet this definition of insurance contract. So by definition, an insurance contract is any contract that passes risk from a policyholder to an issuer of that contract, so much that at a certain date when an uncertain event happens, the insurer is obliged to compensate the policyholder for that loss. So if you are in the business of issuing such kind of contracts, you'd also need to reflect and see whether you need to apply this standard. But for your purposes, I guess you will be mostly looking at this from life insurers, general insurers, reinsurers, and some banks. Next slide, please. So I mentioned before that the journey for Ifrs 17 started way back in 2004 after the interim standard was issued. And the first version of Ifrs 17 was issued in 2017. So some entities actually started implementing Ifrs 17 in 2017 when the first draft was issued. But then in 2020, after some consultation, so when ISP issues a standard, it gives a period of consultation, and then also after issuing a standard, it also engages the insurers themselves, the consultants, and other stakeholders feedback on the standard that they would have issued. So there were so many comments regarding the first draft of Ifrs 17, which led to the first standard being amended on some aspects, and the final amended standard came into effect in 2020. So for most of the entities, especially in East Africa, their journey started then, because very few had actually adopted the earlier version. So most of the companies, their journey started in 2020 and they are still on that journey. So with this standard, because it's the first time standard, every time a standard is issued for the first time, it's supposed to be applied retrospectively. What that means is you are supposed to look at your financial statements 3 years back. So what that means is when the insurance companies first issue their annual reports in December 2023, they would have to present 3 balance sheets for comparative purposes, applying the standard on those 3 balance sheets. So what that also means is that that work needed to start early for the insurers, and for those insurers that haven't started this journey, it's almost getting late for them because it's a huge undertaking to implement the standard. So that's just a view that I wanted to show you in terms of how the insurance journey has been from when the standard was issued to when it's expected to be effective in December 2023. Next slide. Okay, so I know most of you are not accountants or actuaries, so I'm just going to try to simplify this new measurement model that I've spoken to, or this solution that we have now for most of the problems that the insurance companies were facing. So the key components, just click again, David, for the full slide. So I would just want to give you a comparison between the approach that was being used per the old standard, which is Ifrs 4, and the new standard, which is Ifrs 17. So previously, the insurers used to measure the liability by considering their unearned premiums plus an aspect of what they call deferred acquisition cost or asset. So what this is when insurers are getting business, they usually pay a huge amount of cost to, say, brokers or those that bring business to them, and they spread those costs over some time as an asset. So the net of the premiums that they would have received plus those acquisition costs was what was constituting mostly what the liability was on the financial statements, plus of course where they would have incurred claims and haven't paid that, they would add that, and that was the liability on the balance sheet. Now with this new model, it takes a building block approach. So what they are now supposed to do is to look at 4 key aspects in terms of measuring that liability. So the first one would be, they need to look at their future cash flows. So they are supposed to come up with unbiased future cash flows for their contracts. So for example, an insurance contract would look at their contracts and then try to see the best that I could do to just try and simplify how the accounting for insurance contracts has changed from. So here I just wanted to show you a picture of how the 2 income statements would look like. So on my left is the old format of insurance of the profit and loss, and on my right is the new expected format for Ifrs 17. So Ifrs 17 is expected to bring greater clarity on P&L, like I mentioned. So you see from Ifrs 4 that normally the income statement will just be recorded as premiums, then investment income, then incurred claims and expenses, then change in insurance contract liabilities, which was like a lot of adjustments that the actuaries will put through, experience adjustments, etc. And all that will then be called underwriting profit. But now the presentation will be very distinct and presented better. It really brings better clarity to the presentation, because now insurance revenue is presented separately from insurance investment income and insurance finance, and giving a net result. So your underwriting profit now would no longer include things like changes in insurance contract liabilities that you are not very sure what it was, and also it is no longer being driven just by premiums. So you now recognize your revenue as it is, and this will be the presentation that you will see on most of the financial statements as you go forward. And because most of them would present it this way, you see with the older presentation, actually people present it differently depending on how they have measured their insurance contracts. So now it is expected that you see all the financial instruments, all the financial statements for insurance companies presented in this format because it's prescribed. So it becomes very easier for you as media to analyze the insurance revenue or expenses or the profit and loss. Next, please. So this is also a very simplified version of the balance sheet. So on the purple side, I'm showing how the balance sheet is looking now. If there's anything that is cluttered in terms of balance sheet, it's usually how the insurers are presenting their balance sheet, because they break down almost everything in their balance sheet. You would have reinsurance contracts, you'd have deferred acquisition costs, you have value of business acquired, you have premium receivables separately, you have policy loans. But now, because of this new one model, you can only present, it will be very, it will be sort of consolidated. You are only supposed to show your reinsurance contract assets and your insurance contracts assets as your assets, and on your liabilities, you only see your insurance contract liabilities and your reinsurance contract liabilities, and that is it. They have sort of collapsed the previous presentation where multiple lines were presented to just a very simplified presentation on the balance sheet. Again, it makes it easier for you as analysts to just pick what you want to just, so if you just want to know really what is the insurance liability here, you just know you go to that one line written liabilities and you get your number, instead of trying to sum up some of the items that will be broken down unnecessarily. So simplified balance sheet as a solution, we can move on. So lastly, I just wanted to highlight some of the key impacts of the standard, especially on the insurer. They are facing a lot of challenges with the implementation. It really has not been an easy journey for them because it's revamped most of the things that they knew. And so I'll just speak to a few here because I know I'm running out of time. So presentation and disclosures I've already mentioned. We have seen the simplified balance sheet, the simplified P&L. One thing I need to add, although, is the notes have become more. So because we simplified the balance sheet, they are supposed to take most of the disclosures now to the notes. And in those notes, they're supposed to explain. So they're supposed to explain how they have made money and how they have reconciled their liabilities and how they are releasing that profit that they had deferred, so that it becomes very easier for users of financial statements, even laymen, people, to understand how the numbers are being arrived at in the financial statements. The second thing that has changed mostly for them is the systems. So the current systems that they have is not, most of the current systems that I have are not capable of calculating the liabilities per the building block approach that we looked at. So they have to invest in new systems, and they also have to change their processes from the old model to a new sort of model, because the way that they're going to do business has changed. And so that's a major impact, and I think you're likely to see in the first year of implementation very huge costs in terms of purchase of some of these systems, and also them trying to transition, like consultants cost, etc. Another change for them is in terms of people. So IFRS 4 was simpler, and they could do it with a few members like accountants and maybe actuaries. But now for IFRS 17, they even need a lot more talent and people that actually know the standard. So they have the option of either upskilling or even getting new people that know about the standard. So that's a very big change for the insurers. There's also going to be volatility in financial results and equity. So remember where I said previously insurers used to just lock in some assumptions, but now they're supposed to review those assumptions annually. So what that does is to bring a lot of volatility into their profit and loss. As you change the discount rates almost every year, it means your liability changes, and it means your profit and loss becomes more volatile than how it was. And that also applies to equity. So key performance indicators, obviously they will change. Like I mentioned, premiums are no longer driving revenues. And cash is also no longer driving revenue. So some of the KPIs, if they were based on premiums, they would have to change to align to the new standards. Dividend policies also would change or would be affected. And some of the business decisions that usually insurance contracts, so insurers would make, now they really need to rethink on how it would affect their business. So for example, one of the things that probably I didn't mention is that when you issue a contract that is likely to result in a loss, you're supposed to recognize that loss on day one, of which that's something that they were not doing before. So they really have to rethink about how they do business and assess whether all the contracts that they are getting into would be profitable. So that concludes my session, and I'm sorry if I've taken more of your time, but that's a brief highlight of what's coming in 2023 for the insurers. And you need to be aware of it, as you'll be the people probably that will also be analyzing these financial statements. Thank you very much. Back to you, David. Oh, any questions?
Thank you, Lynette. We'll have a look at the question towards the end. And so I would like to welcome Sarah to take us through ESG.
Thank you, Abby. Please confirm you can see and hear me clearly.
Yes.
Yes. Thank you. Give me a minute to put up my slide. So thank you and good morning, everybody. So my name is Sarah Njoroge, as introduced by Abby. I'm going to be taking this session with Lynette. So I'm a manager within KPMG Consulting Business, and I work within the Governance, Risk and Compliance Unit. So this morning, I think it's almost afternoon, we are going to be looking at the topic on environmental, social and governance. And I believe you agree with me that it is a very topical and timely subject for us to discuss. It has been the top of discussion, probably even within media houses, within every other boardroom. It is a conversation that won't be left out by board members as they sit. So Christine did touch quite a bit on ESG, and she did run a poll question where she asked whether you think ESG, or rather the environment, social and governance, do affect a company's bottom line. And I think we all agreed at a 99% rate that yes, it does. And yes, it does is the answer. And I think within the last couple of years, we have seen ESG as a topic, surge and come to the fore and front of most discussions. Looking at, I would say, the COP26 last year in November in Glasgow. If you looked at it, you would see that there was quite a lot of activity, media houses, struggling for space, business journalists, as they looked to listen to the business and world leaders make commitments towards net zero. And if you contrast the same to the COP21 that happened in 2015 in Paris, and this is when the world leaders came together and agreed to came up with a set of the 17 sustainable development goals. Probably the scenario would be different. You would see within the span of the 6-7 years, this topic has gained quite a lot of traction. And as businesses continue to report on this, then I think it is a natural phenomena that the media reporting would follow suit. And what risk then this brings about, I would say, as countries make these net zero commitments, that is the governments, you realize that climate change, the social issues that we are having, it is not just a government problem alone. So even the companies, the individuals, all play a part. So you'll see that at company levels, businesses have also continually started making these kind of commitments. And this definitely does present a risk because there would be temptation, let me call it temptation, by some of our top companies probably to, report on the progress they are making. You will see that like the executive pay and bonuses is becoming linked to ESG performance. What is the risk of mis-selling that comes about, a lot of greenwashing, say by the fund managers and all, as they try to present their products and funds as green. So all that said, probably let's start by asking ourselves, so what is this ESG? And I will request Sharon to run my first poll question, and you may just take a few seconds to respond to that. What do you understand ESG to be? Is it climate change and decarbonization? Is it sustainability? Is it a criteria to measure sustainability impact of a company? Or could it even be a reduction in direct and indirect emissions? So probably Sharon, in the next 10 seconds, you could show us the poll results. Uh-huh. 76% of us say it is a set of criteria to measure, the impact of sustainability. And yes, that is the correct answer, but this word has been used interchangeably, for example, with the word sustainability that you can see there. And the difference is that sustainability is more of a generic measure. Like every other company, as I said, and every other nation then would be looking for ways to become a sustainable nation or become a sustainable business. But then how do we measure this sustainable? How do we tell that we are becoming sustainable? Then it becomes through this set of defined criteria, ESG, the environmental, social, and governance. So with that said, I'll just talk to our agenda, which is just to look at ESG and its drivers. And then we are going to look at the recent developments that have been there from both the regulatory and reporting perspective. We'll then briefly just look at how, as business reporters, how do you look at ESG? How do you pick out what is of interest, to the different stakeholders that are users of these reports. And we'll finalize by just looking at a bit of the benefits and challenges encountered in this journey. So when we define ESG, so within the three categories of environment, social, and governance, there are different parameters that then we look at, and I'm not going to be speaking to this in detail at this point. I'll be looking at it later, but maybe just to mention, under climate change, under environment, the E, I think climate change, and it is what has taken, a lot of prominence because what we are saying that it is climate change is, it is an urgent issue. It is an urgent matter. So even as we look at the entire spectrum of ESG, climate change then is given a lot more preeminence, because we are saying we cannot live in a dying planet. I think the IPCC, that is the Intergovernmental Panel on Climate Change, has come up with science that is showing that you know, as a world, we are consuming natural resources at, they say, 1.7 times more than the you know, the planet and its ecosystem can regenerate. And if we continued at the same rate at which we are moving, then by 2030 we would require at least 2 planets to sustain our current lifestyles. When we look at emissions, the greenhouse gases, you know, this is where the whole story on net zero comes in, as because what we are saying is, to get to a net zero position, it means that as a company, as a country, you are able to remove as much, you know, emission from the environment as you are emitting. And probably it's not practically possible to remove all of it or to reduce completely, because some emission have to be there as part of normal business operations. But then what you need to do then is to come up with measures or rather initiatives to offset the balances of these gases that you still have to emit. The crisis of energy, moving into more, you know, energy efficient operations and the likes. So, and then also, if I were to look at something like biodiversity, probably it's not a word that has been used in our everyday conversation, but science is showing that to date we've lost at least 52% of our biodiversity. What does that mean for us and the future generations? Are we being mindful of the future generation? And then under social, I could just speak maybe to human capital, health and safety. You know, as employers, as businesses, we have to look at the social aspect of our people, be it both the people working for us and even the communities around where these businesses are operating. And more so because as a business, we require the social license, you know, to operate. And this comes from the goodwill we get from the people around us. The topic on diversity and equal opportunity, we cannot even overemphasize that. And then from a governance perspective, much as we are looking at these as environmental and social issues and saying that they are pressing matters, how then do they become embedded into the business models that Christine was talking about? It would have to be through, you know, this institution of governance, and it is the governance in place within the businesses that will oversee, you know, the implementation of the environmental and social initiatives that are required. And so, having said that, why does ESG matter? So this slide here is just showing the global risk landscape. And this is a result of an annual survey that is normally done by the World Economic Forum. From what you can see on the left is a depiction of what the top global risks were, say in 2014 and 2015. And what you realize is that that chart isn't colored as green as what you see in 2020 and 2021. Like, for example, if you look at 2015, most of the risks that were topping the chart were actually geopolitical kind of risks, you know, like failure on national governance, interstate conflicts and the like. But coming to 2020, the whole list of top 5 risks speak to you know, to environment, extreme weather, action, climate action failure. And climate action failure, for example, would be speaking to, we have all these commitments that have been made towards net zero. And actually it is being said that the commitments made so far are not even sufficient to get us to the net zero position we want. So more and more businesses, more and more governments need to make more commitments. So you can see, and coming to 2021, the picture is the same with an addition there on societal issues and mainly stemming from the pandemic that we had. So infectious diseases came up. And from the same research, you can see how the respondent see as a global timeline, like within timelines of 0 to 2 to 5 years, and even up to 10 years, can see green still dominates, meaning that it is actually an urgent and pressing matter that needs to be addressed. And so that said, what have been the main key drivers? What has brought this ESG topic or what has made it to become so important? And number one is the climate change, as I said. So this is what is leading the whole conversation. As a world, we have been on the receiving end, of the wrath of Mother Nature. Floods, the other time you move from floods to drought, wildfires, heat waves, storms, and all this. So it has brought it to the fore from a global perspective. So that mainly speaks to the E. And then the second one there, we are talking about the C-suite and board buy-in, and that speaks to the G, the governance. So as I mentioned, the boards cannot afford to ignore. They have to appreciate that the climate and social issues are there in our time and have to be managed. And so the boards have to consider how to come up with ESG strategies and how to also, embed this within the main business strategies. Regulatory developments, I think we are going to be looking at this, and even here locally, there has been quite a bit of regulatory development, requiring businesses to make disclosures and reports in terms of how they are performing from an ESG lens. Also, from a reporting perspective, globally, there are many standard setting bodies, and these are keeping on coming up with guidance on how to guide, companies across globe to report. Then when we talk about societal pressures, mainly these would speak even to us as the consumer of product and services from the different companies. And what we are saying is that the consumer today is becoming very socially aware. We've seen issues of even boycott to products, and people are willing, especially the millennials, they are willing to, spend a little more for to buy from businesses that they consider to be socially responsible, to be responsible citizens, corporate citizens. Then in terms of access to capital, that would speak to investment and the way investors are looking at their investment criteria. And in those decisions, environmental issues and social becomes part of the scoring that is done. And you can see us saying they are going that like no ESG, no capital. So you will see more and more investors wanting to divest from the brown economy, companies dealing with fossil fuels and the likes, and channeling their money into low carbon kind of investment and companies. And just to finalize, when we talk about the workforce, the employee today, and actually within by 2025 or so, within the next few years, we'll have a lot of, actually research says about 75% of the workforce will be made up of millennials. And these are people who want to work for companies, which they feel that their values are congruent with their own personal values. So those are just some of the factors that have contributed to the rise in ESG. And I think I'm going to hand over to my colleague Lynette to just look at one of the key drivers, which we said is regulation. So Lynette, please.
Thank you, Sarah. And again, Lynette, and here I'll be wearing my other hat as a sustainability expert. So just taking from Sarah, so Sarah mentioned the ESG agenda is also being pushed by regulators. And I just wanted to look at the regulatory landscape, especially here in East Africa. And what we have seen, so if we have been tracking sustainability, especially since 2015 after the Paris Agreement, we have seen that Kenya has tried to keep up to date with sustainability issues, though it can be improved. And I think we are now at that stage where we are seeing a big improvement in terms of the regulators wearing their head and pushing the ESG agenda. So around 2015, the Sustainability Finance Initiative, which was led by the banking sector, was issued. It issued some harmonized guidelines on sustainability development, especially for the banking sector. And in 2016, we also saw the Capital Markets Authority issuing some governance codes that incorporated ESG. And recently, we have seen the Central Bank of Kenya issuing guidance on climate-related risks for banks. And I think it was issued sometime in October 2021, and banks are currently working on implementing this regulation. It has very strict timelines, which I will look at in the next slide. And then we also have the Nairobi Security Exchange. They also released some guidance on sustainability, and their guidance is mostly aligned to the Global Reporting Initiative, which is a global standard setter that I will also talk about in my next slides. Just going across the region, we've also seen that recently, the Dar es Salaam Stock Exchange, they also issued some regulation for all listed companies to include sustainability reporting in their annual reports. And Rwanda also had then the regulator in Rwanda, they also issued some guideline, but around 2019 for banks, requiring them to consider sustainability on an annual basis in their integrated reports. We haven't seen much from Uganda, but I understand discussions with regulators are actually ongoing. So it's highly likely that we will see also some regulations coming up from that aspect. So those are the key players, especially in terms of regulations in East Africa. It's mostly the stock exchanges, the regulators, and some of the associations. Next slide. So I mentioned two key aspects that I wanted to expand on, especially for Kenya, which is the CBK guideline on climate risk management, as well as the NSE's guidelines on disclosure guidance. So the first one, which is the CBK, was issued in October, like I said, and all companies are supposed to be reporting on sustainability in 2023. What the regulator has done is to issue some guidelines that are aligned to a global standard setter, which is TCFD, the Task Force for Climate-Related Financial Disclosures. And banks are supposed to first train their staff as well as their board to sensitize them on climate change issues. And they were given, I think, about 6 or so months from October. They should have done that process by March 22. And by June 22, which is upcoming, they're supposed to be submitting a board-approved implementation plan to the regulator on how they are going to incorporate climate risk into their strategy and governance structures, etc. And then they are expected to give quarterly updates on that plan that they would have issued in June. So the first report should be issued by 30 September 2022. And then finally, they're supposed to then start disclosing they're supposed to disclosing financial related information from January 2023 going forward. So the banks, they really have very limited time now to comply with this regulation. And most of them have been seeking advice from consultants, and some are hiring sustainability managers to help them implement this. The NSE's guideline was mostly given for the listing requirements and for the existing listed entities. They're supposed to start incorporating the GRI reporting standards and issue sustainability reports from 12 months after the issue date. And this guideline was issued in November 2021. So we are expecting that maybe by December 2022, all listed entities should then be disclosing information on ESG in their financial reports. That's fine, we can move. So I think that for media, it's probably to conscientize the key players or those that are affected, and maybe keep reminding them of the deadlines so that they all comply. So that was in terms of regulation. The other key players that are pushing the ESG agenda are the standard setters and framework and principle setters. So when you're looking at the reporting landscape as it is now, it is a framework, sorry, it is a landscape that is very fragmented. And this is because there are so many reporting frameworks. So for someone who just wants to start to know about sustainability, it can become very confusing because you won't even know where to start. So the key players also in this landscape are the standard setters, the stock exchanges, the global stock exchanges, some of the NGOs like United Nations, as well as rating agencies. So here we try to just depict some of the key players in terms of frameworks or principles, or those that issue targets and metrics, or the rating agencies, just to mention a few I think that are common. So when you're talking in terms of standards, we have key players, or like GRI, I think it's one of the widely used framework for sustainability. And in the countries that's usually in the United States, they usually use the SASB, which is the Sustainability Accounting Standard Board. And the TCFD also is also widely used. Like I've mentioned, even us here in Kenya, the regulator for banks is aligning to the TCFD framework. I'll just highlight a few of these frameworks because there are a lot. But like what Christine had said, we need to be reading, especially if you are going to be playing in this sustainability space, because there's what we call, or what has been referred to as the alphabet soup. Just referring to, there's so many frameworks and there's so many acronyms that you need to be aware of or get used to. So just touching a bit on just maybe 3 key players in the standard setting framework. We have what you call the TCFD, which stands for the Task Force of Climate Related Financial Disclosures, and henceforth I'll just call it TCFD. So this framework was developed in 2015, soon after the Paris Agreement, and it's a board that is constituted of banks, consulting firms, some standard setters, and some NGOs. And they were tasked to come up with recommendations that could help companies to report on climate change. So it's really a climate-focused framework and nothing else. So they came up with content that is structured in 4 key areas. So entities are supposed to report on governance issues. So looking at the processes around how the companies run and how it's managing its climate risk, as well as strategy. So looking at how the strategy is affected by climate risk and how resilient that strategy is. They're supposed to disclose all that. Also, they're supposed to disclose their risk management processes. How do they identify risks? How do they mitigate those risks? And lastly, they're supposed to disclose on metrics and targets. So what KPIs are they using to measure some of these aspects on climate risks, and what are their targets? How do they arrive at those targets? So those are the key, or what they call the core elements of disclosures under the TCFD. We also have the GRI, which is widely used from some surveys that have been done. I think most of the organizations that disclose sustainability information, they use the GRI, including some of the key players in Kenya, like Safaricom, KCB, EABL, etc. So this this framework is not climate specific like TCFD. It looks at the broader ESG aspect. So it has elements of environmental, of social, and of economic factors that it asks people to disclose on. And it's also applicable to almost all industry organizations. And it's also have standards that are like 3 key standards that are applicable to everyone, plus it has also specific standards that are applicable to just specific sectors like maybe mining or ENR. And then it also have standards that are specific to topics. So like when you're looking at maybe the E itself, the S itself, and the G itself. The good thing, if you want to know more about GRI, is all their standards are free. And you can go to their site and you can read more on the standards. Same with the TCFD. They even have a whole hub where you can just do trainings and get certificates that can help with your career as a sustainability maybe expert. And lastly, the SASB is also heavily climate focused, but it's also focuses on investors. It's investor focus. It focuses on giving investors the information that they need to understand about the financial impacts of ESG on an organization. So the key challenge I've mentioned with having all these frameworks was that it means global comparability is a challenge, because one organization could be using SASB, another one GRI, and they are as much as they complement each other, they're also different. So the way that they look, say, for example, at materiality, or what is considered to be material to be disclosed, is different. And what that means is you can't really compare one report to another, because they would have used different frameworks. So next slide. So where we are going now is we're going towards consolidation of all these frameworks. What the market and the investors have been asking for, especially from these standards setters, is for alignment. Like, can we just have at least one global standard that we can use, so that we can compare different companies across different jurisdictions? So most of these investors or stakeholders, they have approached the International Financial Standard Reporting Standard based on its work that it has done, especially on IFRS, and because it's also widely accepted, like I think it's applicable in about 140 jurisdictions. So they approached the International Accounting Standard Board and asked whether they could come up with a standard that at least addresses all aspects of ESG and it's global. So the standard setting board started its consultation process with these stakeholders in September 2020. And they heeded to the cry of most of the stakeholders, and they set up what we call now the International Sustainability Standard Board, which was announced at COP26, if we were following that. So what the Ifrs board have decided to do is that they are going to consolidate most of the frameworks that I've spoken about. So like the Sustainability Accounting Standard Board, the Integrated Reporting Framework, the other frameworks like CDSB that we really didn't discuss, but you can look into, and the Climate Disclosure, sorry, that's the Climate Disclosure Board, and the World Economic Forum. All those frameworks are now going to be consolidated, and they will come up with at least a global baseline for climate reporting. So that's good news for most stakeholders, really, be it investors or even us as users of financial statements, because what that means is we would now move from a very fragmented landscape to at least one that is aligned globally. And so this standard, I'll just want to talk briefly about it in terms of what it's talking about, when is the effective date, and the structure in a few slides. It's very key, because you see, like most of the jurisdictions really apply IFRS. So it's very likely that they will move towards applying this standard because of how it's a global standard, and also it has managed to at least consolidate most of the principles and frameworks and measurement principles coming from those players that were already there doing sustainability. So they have issued at the end of March, I think 31 March, they issued 2 exposure drafts of their standards. One that is called the general requirements for disclosures standard, which generally is a framework on how to look at sustainability. It defines the scope and objectives of the reporting, and also it highlights the core element of how to present these financial statements. If you're familiar with the International Accounting Standard, it's more similar to what we call the conceptual framework. It just sets a baseline for the upcoming standards. So they've also come up with what is the climate-related disclosure. So what the IFRS board decided to do was to start with the climate disclosure proposals, because that's what the stakeholders have asked for. They have said climate is critical, but it doesn't mean that they will only focus on climate. So after the issue of the climate proposal, we're expecting also other proposals to touch on other aspects of ESG, as they were already there on the other frameworks. So just looking deeper into these 2 standards, how they are structured at a glance. So in terms of how they define what a reporting framework, it is similar to how it is defined in IFRS. I think they just tried to make it simpler for implementation purposes. So when you're looking at a reporting entity in IFRS, it's the same way that you look at a reporting entity when it comes to sustainability reporting. So if you have been reporting as a group, you can also report as a group in terms of sustainability. What it does, however, is that it asks for the reporting also to reflect about the broader resources and relationship in the value chain. So over and above just be the reporting entity, it expects the stakeholders to also assess the climate risk and opportunities that are coming from its value chain, from its suppliers, or from its other stakeholders, and also include that as part of the disclosures, because they do realize that entities, they don't operate on their own. So that's about that. Then in terms of disclosure topics, they have set materiality, and it's also aligned to the way that we are used to defining materiality in the International Accounting Standard. So they say you disclose anything that you consider material, and materiality is anything that will influence the users of those reports when they're assessing the enterprise value. And they define enterprise value as your equity plus your debt. So anything that you think would influence an investor's assessment of enterprise value would be what you consider when you are considering what to disclose in terms of certain topics. Then in terms of content and the structure, they have literally just copied the structure that the TCFD followed. I hope I mentioned that TCFD is also part of this board. So if you're familiar with TCFD, or if you had already been reporting on TCFD, companies will find it easier to transition to this new framework. So all disclosures are supposed to be on governance, on strategy, on risk management, and on metrics. And then lastly, they have asked for connectivity between the sustainability report and the financial statements. So that link between your report, your sustainability report, and your financial statements is very important. They have not asked for a separate report, so you could still use your annual report, but you need to be able to cross-reference your information so that it's very easy for users of financial statements to link between your sustainability report and your financial statements. Next slide. So in terms of timelines, So at the COP26, when they announced the formation of the ISSB, they also mentioned that because of the demand for this consolidated framework, they were going to follow a very accelerated process. So normally a standard setting takes a bit of time, like 2-3 years. I've mentioned when I was looking at Ifrs 17 that it even took them 10 years. But for this one, they committed to having the final, at least maybe 2 of the final standard by end of 2022. So from the time that the board was issued in November, they started working on the consolidation process and coming up with the standards, and they finally issued their exposure drafts on 31 March 2022. So these drafts are actually open for commentary. If you have time, you can look at them. There are 2 and they are not very onerous, like for some of us who are used to reading very huge standards. They are very brief, and you can also have a look at them. And if you want to give comment, there are channels that you can give comments on them. I believe as media, you also have a part to play in some of these standards. So this is your time or your chance to make change. So the deliberation process is, the deadline for comment is supposed to be 29 July 2022. And then after that, there will be a deliberation process where they're looking at those comments. And then finally, they'll issue a standard before the end of 2022. They didn't give a specific date. So what that means for most of us is that we are expecting that by 2023, probably we'll be having new global standards, and because they are aligned to the frameworks that we have already reporting on, it is easy for companies to move over to them. So the ISSB does not really, it doesn't give the standards as mandatory, but it's up to the regulators in the local jurisdictions to make such calls. It's also the same for assurance. They don't really say you need to get auditors, but it's up to the regulators then to make that call. So I think that is it that I wanted to highlight on the regulatory and the global developments. Key things is the regulations that are really upcoming. Just have time and go and look at them and see how they will impact you as the media industry. Thank you.
Thank you, Lynette. So I'm going to, as we head towards the end, I'm going to take this section on how to dissect an ESG report for you as a business reporter. Then all these ESG disclosures, where are you going to find them? And I think Lynette just started on it by mentioning that there really isn't like a prescription in terms of where or how, or rather where businesses need to report, and it depends really. So you will find that some businesses, or rather some companies, just include this ESG information into their the annual report, and this would mainly be on the front section of the report. Still at it, some companies would choose to do a separate sustainability report, and this would be mainly those that are reporting, more rigorous reporting in terms of the disclosures that they include, but that doesn't restrict them from still cross-referencing and bringing into the annual report some of those, key parameters that they are tracking from an ESG perspective. And whether it needs to be audited, Lynette has mentioned that it's not a requirement, but you'd find probably with time as, the reporting matures, the regulators may require for assurance. And even before that comes, still at some companies may choose still to get their reports assured for credibility purposes. So, those are just some of the reports where you would find those ESG reports. In annual reports, mainly it would be for those companies that are only including a few ESG parameters. A complete set of sustainability report for those companies that are, have fully fledged sustainability reports. And then integrated report, normally, it's maturity in corporate reporting, more to say in that order, where you'll find a company has a complete sustainability report. but then wants to filter even more and come up with an integrated report. This report mainly is used by the, the investors, the providers of financial capital. A sustainability report covers a wider group of stakeholders who would be interested. So, and it would also be in some ad hoc sort of communication issued by companies like press releases. So those are just some of the places you would find. And when you get this report, this is just a snapshot of what you would probably look out for. So the circles they are showing, the typical kind of sections you'll find in an integrated or even a sustainability report. So you'll find a section talking about this report, and in that section, they'll mainly just talk about the reporting approach that has been used. The company will be stating of those several reporting frameworks that Lynette has talked to, which one did the business adopt? And, explaining which reporting standard they used would give you an idea as to whether the report mainly say concentrates on the impact of the business on the environment and society, or vice versa, where you look at the impact of the climate, for example, or the environment generally on the business model. And it would also tell you whether the report has been assured and all that. Then there would be some non-financial and financial highlights section, just summaries, qualitative and quantitative. Then business model, Christine mentioned about that, and that is basically how the business does what it does. What are the inputs? What are the processes around it? What are the outputs? What are the outcomes and impacts of them running that business? Then the key area would be the section on material issues. So every business would have gone through a rigorous process in determining what really matters for their business from an ESG perspective, and also what would affect, or what would their stakeholders consider when making their decisions. And all those material issues would be reported there in a prioritized manner. And then the whole report then would be built around those material issues. Like you'd be looking at when they present their strategy, is it responding? Is it responsive to address all those issues that are key for them then? When you look at their risk management, has it considered these material issues? And then you'd look at the performance reviews, and there basically it's the leadership reports, the chairman, CEO, and the CFO. And the chairman, for example, would basically be talking to how did the say the strategy change during the year? Did they bring on board a lot more ESG staff? And then the CEO would be telling us how that strategy, indeed it changed. How has it been executed? What's the direction that the business is heading towards? And the CFO would then be telling us what was the financial implication of executing this strategy. And finally, the corporate governance section. And you don't want just to look at it as, it's no longer a section to just highlight who the directors are. What you would be interested with as a reporter is to see, the different committees that are in place, how many times, or not necessarily how many times did they sit, but you want to see what was the outcome of their discussions. And in those committee reports, ideally, you should be able to see them addressing these material issues. How did they develop during the year? And as you engage these business leaders, then those are just some of the issues that probably you need to put them to task to be able to explain. So that said, I'm going to look at some of the disclosures in brief, very brief, because I'm cognizant that time is not on our side. So some of the economic and governance disclosures there, and these are based on the GRI standard. As Lynette said or mentioned, the GRI standard is one of the most widely adopted. Probably about 90% of the businesses worldwide reporting on sustainability and ESG are reporting on this framework. So some of the things you would see them reporting there would be on the economic performance, just highlights on how the business performed in terms of value, direct economic value generated, distributed, and retained, and that is in form of revenue, expenses, and retained earnings. When you look at something like anti-corruption, it's a governance issue. You would be looking at have there been cases of fraud and corruption during the year? What are the kind of assessments and reviews that have been done? And it goes to the extent of requiring these businesses to report on what were the outcome. When you look at something like procurement practices, ideally we want to see for these businesses and especially the big multinational businesses, what is the spend that they are spending on the local suppliers. And I think this is just a sneak peek from the Safaricom report prepared by KPMG. You can just see some of the things that businesses report on from an economic stroke governance perspective. If you see like they are reporting on the impact on society, 9.7, that is an indirect kind of economic benefit that is showing the true or the real value the company is generating. You can see the procurement spend rates disclosed. And when you dig deeper into the report, you will see the explanations on that. You can see they're also reporting on matters like cybersecurity, data privacy, and all that. And that is just what I talked about. The Safaricom report, sustainability report, is reporting on the anti-corruption monitoring measures in place and the outcomes of the same. So looking at environmental, maybe the key thing here and the main parameter you'll see most business reporting on is the emissions, categorized in the 3 categories as described by the GHG protocol, that is the greenhouse gas reporting protocol, and that is scope 1 emissions, scope 2 and scope 3. Scope 1 talks to the emissions that are directly controlled by the business, and that would mainly be in terms of fuels, by company-owned vehicles. When you look at scope 2, it would mainly be looking at purchased, generated or purchased electricity, and scope 3, it is all those emissions within the value chain. When you look at something like effluents and waste, you want to see these businesses disclosing on recycling practices, and where they're not able to recycle, then how are they going about their disposal? And then you also want to see about environmental compliance. Are there instances where they didn't comply? Were there any penalties and fines imposed on them? And again, that is just a sneak peek of some of those. So you can see they are reporting on their carbon footprint, water consumption and the likes. And you see they're also disclosing on their net zero targets, where I have highlighted the snapshots highlighted in yellow here. And they go ahead, making a balanced kind of a disclosure in terms of saying which of these targets have they been able to meet, which ones were they not able to meet, and going ahead to explain the reasons for each of those. And I think that is just one of the principles of sustainability reporting, where businesses are expected to report on both the positive and negative impacts that they have on the society and environment. And just further sneak peeks, you can see on the energy initiatives, they report where they were able to increase or cut on emissions. They report on the energy initiatives that they have in place. And you can see also details here on waste, how waste has been managed, how much they've been able to recycle and the likes. So as a business reporter, these are some of the areas that you'd be looking at in a report. And finally, there would be social disclosures, and these are many, about 19 of them. And companies will not generally report on all of them. They'll only go into details explaining those that they picked out as material for their business and their stakeholders. So if I touch on maybe one or two, like employment, it would be talking on this, staff turnover rates and even the hiring turnover during the hiring that happened during the year, and the kind of information that would be disclosed, gives an investor or even a reader much more insights into what is happening within a company. You're able to tell whether, employees are satisfied. If there are very high turnovers, this is lost both in terms of human and intellectual capital. And it would also probably raise more questions like, are there changes, in operations, or what is happening? And from an impact perspective, when you see the turnovers are very high, turnover rate is very high, it also points to additional costs for the business because they are going to have to keep hiring and replacing these people. When you talk about training and education, is the business investing in its people, sponsoring them to take courses, and even to some extent, you'll find them reporting as to whether they are open to giving sabbatical leaves for people to, skill themselves. And also something else you would see them reporting on is whether they are giving their people the type of training, the type of skills they are building in their employees. Are these skills for the future? And I think when you talk of something like customer health and safety, it is very key. Customers want to be told of the health implications, of the products that they are buying. So I'm just going to rush over that. You can see sample disclosures here. The kind of training and career development. They report on the CPD hours that employees have been able to obtain during the year. And you can see even parameters on diversity here. To the extent, of showing within the different categories, the employee and even the executive, how are the movements during the year. If at some level, probably they lost more, they explain what happened. And these are the kind of disclosures that we are talking about. You see, they are going to the extent of reporting on the inclusivity perspective from a point of having people with disability within their workforce. So I think I am going to leave it at that. And Lynette, request you to just wrap it up by talking briefly to the benefits and challenges before we then move to the Q&A session.
Thank you, Sarah. So I'll just touch on some of the benefits. I know we have highlighted some challenges as we were going through the proposal, but there are also some benefits that come through as a result of integrating ESG in business strategies, or just being an organization that report on issues of sustainability. And one of them is enhanced capital access. So most financial institutions are now considering ESG when they are issuing loans, and there are some loans that are actually just set for people that would have complied with some KPIs as a way, some ESG KPIs as a way of trying to encourage and trying to push the ESG agenda. So you increase your access to capital. And also in terms of investors, there are some investors that are also looking for sustainable, so for companies that report on sustainable profits rather than just profits, they're looking beyond how are you making that profit? Are you impacting the environment when you're making that profit? So most investors now care, and like I mentioned, most of the frameworks that are coming up now is actually as a result of investors' call. They want to know how sustainable businesses are before they make their investment. So if you are aligning and if you're integrating ESG in your strategy, you improve how you look to investors. You also improve your reputation to the general stakeholders like employees, customers. They consider entities that are considering sustainability more attractive than those that are not, because it shows that they do care about the future. And it also gives you a competitive edge if you're a company and your other competitors are behind in terms of incorporating ESG in their environment, in their strategies. Next slide. So lastly, we just wanted to highlight some of the challenges that are coming up as a result of trying to report on ESG or because of the current landscape as it is. So one of them is lack of guidance in terms of KPIs and matrices. So some of the frameworks, as much as we have mentioned that there are many, they don't really go into the details on how to determine some of these key metrics. Is like, how do you really measure your emissions, and how can you maybe get carbon credits, etc. The technicalities around KPIs and metrics are not in some of the standards. So it's still an issue, and we hopefully the new ISB will also look into this and try to give a solution to that challenge. There's also an issue with data, quality ESG data. It's like when you're considering metrics and targets and just how to rank entities in terms of ESG, there's really no data that is widely available currently. So we have like rating agencies that are trying, but we can't really say the availability of data has improved. So insufficient data quality is one of the things that is affecting the quality of some of the ESG reports. And also because of the number of frameworks that are there, you find that the definition of what they call material risk is varied amongst all those frameworks. So it brings a challenge, especially if you are starting your journey, like which you will be challenged in terms of which materiality definition do you go with, which one is the best framework, etc. There's also a talent gap in terms of expertise. We have realized, yes, that ESG has become topical, but most organizations do not have the expertise, the people with the sustainability experts, and especially those that that do pollute the organization. There's a general lack of experts that can help with decarbonization, also lack of the technology to drive meaningful insights into some of these ESG data. So those are some of the challenges that are there when it comes to ESG reporting, but hopefully as the frameworks and the standard status continue to work on this ESG factors, they will be resolved with time. Otherwise, thank you very much. I'll hand over to David, and also Bernard, I don't know if you wanted to say a few remarks before we end the session.
Thank you, Lynette. Very quickly, I don't know, maybe I dropped off at some point, maybe just to check if we answered the question on the implementation timeframe.
So I'm going to do that now. Now that I'm off the screen, I'll answer the questions in the Q&A.
Okay, maybe just quickly go through them, then I can.
Okay, thank you.
Okay, thank you so much, Lynette, Sarah, for that comprehensive presentation around ESG. And we are going to quickly go through some questions. Most of them have been answered live, and in the interest of time, we may not have really to answer all of them, but we can assure you that we will send the responses as we'll be sending the slides, as well as the recording of this whole training. So quickly, I would like to bring you back, Lynette, to answer a question by Vincent Owino, who asked that you elaborate how or what IFR 17 has to do with ESG in the insurance industry, the connection between IFR 17 and ESG in the insurance industry, quickly.
Hi. Thanks, David. So the current standard as it is, it doesn't really specifically address some of the issues that are coming on ESG, but maybe we just looking at some of the assumptions that actuaries make. There are some elements, maybe if in instances that they would be affected by climate risk, that would affect the valuation of some of the insurance contracts. So for example, for insurers that that are in the business of issuing products that protect against climate. It means that whoever values the liabilities has to take into account the impact of climate risk on that portfolio. So that could affect the profitability of that portfolio and can lead to that portfolio being onerous. And like I mentioned, if that portfolio is onerous, it means then they are supposed to recognize profit from day one. So that's one of the ways that I can see climate risk, especially affecting the Ifrs 17 standard.
Thank you so much, Lynette. Good. So maybe you can also handle this one. How does one determine the best ESG framework to use?
Sorry, come again. So how does one choose the best framework
ESG
to use?
Framework.
Okay. Okay, so I think one of the things that you have to consider is what do you want to disclose? Like one of the things that you consider is like considering materiality assessment. What are your material topics and which frameworks really speaks to your material topics that you have identified. So like I mentioned, there are some frameworks that are really globally used because they address most of the aspects in ESG. So like the GRI, it has been found it addresses most of the aspects or most of the material topics that you can pick. So you might then be aligned to choosing the GRI over maybe the SA, the standard accounting disclosures. And then also, it also depends with your jurisdiction, if I may say. So we have realized, so people that are maybe in the Eurozone, they are aligned to the frameworks that are speaking to the Eurozone, like for example, the EU taxonomy and the other frameworks that we didn't mention is because they're applicable to that zone. And entities that maybe in the US are mostly aligned to the sustainability accounting standard boards because they were formed there and they address specific issues that are in that jurisdictions. And then here in Africa, we're mostly aligned to GRI and maybe TCFD because they are they have that global aspect to it. So what really determines is what you have considered is material to your organization. And then you look at the frameworks and see which framework is addressing that. What we have seen in practice is that companies usually combine frameworks. So there's nothing that stops you from using more than one framework. You can actually use the combination of GRI and TCFD if you see how, just to address the risks that you would have identified.
Yeah, Lynette, maybe just to chip in there, if you look at the principles that are being used of the frameworks, in Kenya, the stock exchanges like our Nairobi Stock Exchange has taken a view on GRI. If you look at the climate risk management guidelines by the CBK, they have taken the TCFD. If you look at 2 countries only in Africa that has taken a view on proper guidelines on ESG disclosures and reporting, it's only Kenya and Nigeria that is listed among the countries globally. So Kenya is using GRI and CDP, and Nigeria has just taken GRI. But I do agree with you, it's still not unified. And that's why everybody is looking at what the International Sustainability Standards Board will be putting forward with the IFRS Foundation.
Okay, thank you so much, Bernard. And
so David, there's also another question. Maybe I was about to type a response. It says, how long does it, let me look for it. How long do organizations have in order to fully implement Ifrs 17? So looking at where we are in terms of timelines, the standard is effective 1 January 2023. So the expectation is that by that date, most of the companies would be going live in terms of Ifrs 17. So that means there are about roughly six months left for insurers to implement the standard. But then I also don't know whether the person wanted to know how long it takes to fully implement Ifrs 17, because the question is not very clear. And maybe my response to that would be, it depends. So for some very small organization, it can take the remaining 6 months to actually fully implement Ifrs 17, or even 4 months. But for big organization, they need more time because of the various processes that are there in terms of looking at your processes, your systems, acquiring systems, etc. So we have seen some actually taking a full year to just fully implement the standard.
Thank you. Maybe you can also answer a question that is tied to that. What will happen to those businesses that will not have transitioned by the deadline?
So those businesses would not be in compliance with the standards. So if you are reporting on IFRS, you're supposed to comply with all applicable standards. So it would mean that in their financial statements, they can't put that statement of compliance to say they are in compliance with the standard. Then in terms of local, I don't know if there are any penalties that the regulators will give on that, but the key one is that you would not be in compliance. And you see, if you're not in compliance, your auditors will also give you a disclaimer or a qualified opinion on your report, which is not a situation you would want to be in.
Thank you so much, Lynette. Allow me to just hand one more question in the interest of time. And thank you so much, ladies and gentlemen, for indulging us for the extra time that we have taken for this training. On this one, I would like to bring Bernard to make a few comments on a few matters. One, Bernard, I would like you to, there's a question around the capacity of organizations to handle it. It's just disappeared. Let me just quickly look for it. Basically around organizations' capacity to report on ESG. And then secondly, there is a question that had been asked by Ahmed Hussein on whether we invest on ESG. And I would like you to make a comment, a brief comment on what KPMG is doing on its ESG commitment and investment. Welcome, Bernard.
Thank you very much, David, for that. Definitely there is a capacity issue. And I think, David, this is why we want to thank you. One of the ways that we are coming in as a firm is to avail building that capacity by running these trainings with the key stakeholders to build that public trust. Because what we see, even when we come back to implementation of the ESG factors, most of the things is just mapping. Organizations wait for regulation, and then they just map activities to the areas of ESG. So they just say, yes, as an organization, we are doing A, B, C, D, and they map it. But now there is what we call the impact investing that is now being driven, and they say, can you demonstrate that you are channeling capital in the financial system in the impact areas? And just talking to what you've asked, KPMG is investing heavily in its impact plan, where $1.5 billion has been put in place to help us develop capacity and also build solutions that will help bring the change that is required in the ESG reporting space and beyond. So that is to help also in the SDG areas and some of the key areas that ESG is meant to impact. And we have a very robust plan into coming net zero by 2020, David, 2020, 2020, 30, 2050 in that particular journey. So I don't know, David, I will want to stop it there, but that is what I would like to say.
Thank you so much, Bernard. Allow me just, I direct this to Sarah, and this is going to be our last question, and then I'm going to make some comments around the certificates and also the recording. So Sarah, when writing an ESG report, how do you determine if the impact of the content is good? In other words, I think the person would like to know, how do you know that the content is going to be is sort of you're writing something that is effective. Over to you, Sarah.
Okay, thank you, David. I think as we said, one of the key requirement for this kind of report is that they should be balanced. And what you will find is that as companies or organizations report on their, the way they have been performing or they have performed on the KPIs they set against the different material topics, they would be highlighting where the impact has been positive or even where the impact has been negative. For example, you saw in the Safaricom report, they would be saying their target has been to reduce their emissions, for example, as they work to meeting their net zero targets by 2050. But then they go ahead and say, within this current year, our emissions actually increased. But then they still give some explanations that in as much as the emissions went up, this was because we expanded our, say, infrastructure network in fiber. So ideally, when you deep dive into those reports, you would be able to see whether both the positive and negative impacts have been captured.
Thank you so much, Sarah. And thank you so much, our panelists and presenters today for taking us through that impactful training. We started in the morning with media ethics and also financial reporting and ethical journalism from Christine Guku, who took us extensively on issues to do with emerging trends and how you can work ethically as a journalist. We've heard from our senior manager, that is Johnson Nyika, who took us through accounting standards as well as developments that have taken place. And he was joined by Lynette, who took us through in-depth on IFRS 17 specifically. And in the later stages of the training, we've heard from both Lynette and Sarah around environmental social governance. So ladies and gentlemen, we are coming to the end of our training today. I've seen a question around how will the certificates be issued for this particular session be issued. Remember, we had indicated in the training invite that the training, the certificate will be issued to participants who complete at least 120 minutes of this training. Most of you have done that if you're still on this session at this point, and therefore you can be sure that we are going to send you a certificate. So we will endeavor to do this within a week's time, and we'll send those certificates on your through to your emails. Lastly, allow me to give a vote of thanks, first and foremost to our partners in this particular training, and that is the Media Council of Kenya, for your input and also the support that you have accorded us in the course of this preparation for this particular training, and also coming to talk to your members about issues to do with ethics and other areas that Christine trained on this morning. I would also like to thank my colleagues from KPMG East Africa, that is Abija, for guiding this particular session appropriately, and also the team that worked on the presentation and presented, that is Bernard Amuka, who is our partner in consulting, and also Lynette, who is the associate director, still within the same department, supported also by Sarah. Then in addition to that, I would also like to thank you, the participants, for staying long for this particular presentation. We know that we have taken a bit of time than it had earlier scheduled, but you can all tell that it was worth it because of the insights that have been shared on this particular presentation. Then I would like to point out that we'll continue to work on similar trainings, so be on the lookout for these invites. We continue to partner with the Media Council of Kenya to make these trainings more impactful, to make them more insightful, so that we can continue to build your capacity to ensure that you are able to inform the public with facts and also from an informed position. So thank you so much, ladies and gentlemen. And I'd like to say that we can close the training at that point. Thank you and have a good day.